The U.S. federal government managed to overcome the crisis with 2 days left before the expected debit of default. On June 3rd, local time, U.S. President Joe Biden signed the National Fiscal Responsibility Act, which increases the federal government debt ceiling. The agreement, which passed the House of Representatives on May 31st and the Senate on June 1st, took effect immediately with the signature of President Biden. The U.S. has been able to resolve its default fears over the next 2 years. Instead of raising the federal debt ceiling through January 2025, the agreement would limit spending in fiscal year 2024 and keep the budget for 2025 by up to 1%. Treasury issuance puts a greater strain on the already fragile U.S. banking system. A move by individual investors to invest in short-term treasuries could add pressures on bank deposit to decline. The pressure to reduce deposits could rise again in the wake of massive U.S. Treasury issuance. The U.S. stock and bonds markets will able to be adversely affected. In the short term, the stock market may rebound as the default uncertainty is resolved, but in the end, large-scale government bond issuance will absorb liquidity in the market, putting a burden on the stock and bonds markets. This is because liquidity for stocks and other assets is shrinking as money is concentrated on buying short-term U.S. Treasuries. However, as the U.S. Treasury Department issuing large-scale government bonds, there are growing concerns about the crowd-out effect that absorbs a large amount of liquidity in the market. As President Biden signs a bill to raise the debt ceiling, the U.S. Treasury greatly expands the size of government bonds issuance to fill the coffers, and if even the issuance of government bonds surges in the aftermath of the banking crisis, market liquidity could be significantly reduced. The crowding out effect is a phenomenon in which an increase in government spending leads to an increase in the interest rate and decrease in private investment. A decrease in private sector investment or consumption due to an increase in government spending. In order for the government to increase spending without raising taxes to stimulate the economy, it must borrow money by issuing government bonds. In that case, the amount of money that can be borrowed from the private sector will decrease. Raising interest rates and reducing private investment and consumption. Ultimately, the decrease in investment and consumption results in a decrease in the increase in production that will be created in the private sector, which offsets the increase in production caused by the government's fiscal spending. When the economy is in recession, the crowding out effect may not be large because private investment demand is low. The more normal or booming the economy, the more pronounced the crowding out effect can be.